Are stocks vulnerable to disruption? By www.options-trading-education.com. Many investors are very optimistic, and their purchases are driving the market ever higher. But there are a lot of things going on in the near future that could affect the market. Are stocks vulnerable to disruption right now? Forbes looks at the issue. This week will be a huge week for markets. Stocks continue to hover around record highs. Rates, the 10-year yield, sit at the highest level in 3 years. The market believes that Trump pro-growth story, but there are potential flies in the ointment. The Fed meets and will probably raise interest rates a smidgen. The United Kingdom is ready to officially leave the European Union. Then the Bank of Japan and Bank of England both meet to set rates. And finally, the G20 finance ministers meet where there will be a lot of questions for the U.S. representative to answer about trade barriers, potential trade wars, and the like. Any of these factors could make stocks and their rise vulnerable to disruption. Economic stimulus, inflation, and interest rates. The market rally is based on Trump's promise of economic stimulus with tax cuts, repatriation of corporate cash from offshore, and massive infrastructure spending. So far, none of this has happened as the new administration has focused on immigration, repealing the Affordable Care Act, and a variety of other social issues, such as gender-based bathroom privileges. If economic stimulus gets delayed or does not happen, the market correction will be impressive. If economic stimulus comes to be and starts to overheat, the economy inflation will return, and the Fed will increase the pace at which it is upping interest rates. Either runaway inflation or a recession from too high interest rates would be a problem. Thus, stocks are vulnerable to disruption. United Kingdom, European Union, and Japan. The USA has done the best job of recovering from the Great Recession. Japan, the European Union, and the United Kingdom have moved in and out of recession again. Disruptions caused by troubles with the United Kingdom breakup with the European Union will be felt across the Atlantic, and aggressive changes in monetary or fiscal policy in Japan will send ripples across the Pacific. This is not to mention what happens if the void left by the U.S. leaving the TPP is filled by China. Big talk or real trade war or currency deal. Barron's speculates that a Trump-China currency deal can avert a trade war. They suggest a new Plaza Accord, which refers to the 1985 currency agreement to adjust the value of the greenback versus other currencies. A Plaza reunion may be just the thing to talk Team Trump down from the trade war ledge on which it's perched. The focus of a new accord wouldn't be Japan, but China. Beijing is struggling to support the yuan as traders bid it lower. That battle, which has driven China's foreign reserves below the $3 trillion mark, is largely aimed at placating Trump. Sure, some of this support effort is about halting capital outflows. But Beijing's duel with traders who think the yuan is overvalued is about avoiding the 45% tariffs Trump pledged on the campaign trail. That risk has China again flouting the International Monetary Fund conventions it promised to honor. Its inclusion in the IMF Special Drawing Rights Program in 2016 means Xi Jinping's government should bow to market views about the yuan's value. It should be sharply lower as investors weigh Beijing's debt profile, bubbles, and slowing growth prospects. However, Beijing is taking a short-term hit in an attempt to avoid long-term economic damage from a damaged trade relationship with the USA. Thus, there are lots of balls in the air as the administration, the Fed, various central banks, and the Chinese hierarchy aim to further their own best interests, and any one of these factors could make stocks vulnerable to disruption. For more insights and useful information about options and options trading, visit www.options-trading-education.com.